So, hello everyone. Today I'm gonna be discussing the patterns and technical analysis. So this webinar aims to help participants understand and use chart patterns for better decision making in financial market. So you're gonna be able to recognize and interpret patterns to predict market trends and the price movements. So after this course, you're gonna be able to know what are the reversal chart patterns, how the chart is gonna be moving after these patterns, and how to trade them. So the first reversal chart pattern is gonna be the head and shoulder top, which is a bearish reversal pattern that typically forms after an uptrend and signals a potential trend reversal from bullish to bearish. So as we can see in this figure, we have an uptrend. After it, we have this head and shoulder top, and after it, we're gonna have a downtrend. So what are the key characteristics of the head and shoulder top? So when the price rises up to a peak during the uptrend, a left shoulder is gonna be forming. After it, we're gonna have a pullback. Then the price is gonna move up and forming the head, where the head is gonna be higher than the left shoulder. And after it, we're gonna have a second pullback, where the price is gonna rise again and forming a right shoulder, and it is gonna be lower than the head. And as we can see, the neckline here is forming a support line. So the neckline is the support line of the head and shoulder. So during this pattern, the volume is often higher during the formation of the left shoulder and the head, and after it is going to be decreasing during the formation of the right shoulder. So it is a noticeable increase in volume where it's going to be occurring when the price breaks below the neckline, confirming the pattern. So to confirm this pattern, the price breaks below the neckline, and traders often wait for this breakout to confirm the reversal before taking bearish position. And the projected price decline is estimated by measuring the distance from the head to the neckline and then extending that distance downward from the breakout point, and this provides a target for the potential downward move. And what I mean is when we can draw a vertical line from the head to the neckline, and then we are gonna do a copy paste for it downward under the breakout, under the neckline, and at the end of the vertical line we're gonna put our target, which is gonna be the take profit, and here we're gonna put our stop loss. So to know our target, we should only draw a vertical line, do a copy paste for it, and indicate our target, which is gonna be the take profit. Secondly, we have the head and shoulder bottom, which is also known as an inverse head and shoulders, and it is a bullish reversal pattern that typically forms after downtrend and signals a potential reversal from bearish to bullish. So it occurs after a downtrend. Here is the head and shoulder bottom, and after it we're gonna have an uptrend. So the key characteristics of it is when the price declines, forming a downtrend, we're gonna have our first left hand shoulder, and after it we're gonna have a brief rally from the left shoulder. Then the price drops to a lower trough, forming the head, and the head is lower than the left and right shoulders. As we can see in this picture, it is lower than the left and the right shoulder. So after it, we're gonna also have another rally, and the price falls again, but usually fails to reach the depth of the head, forming the right shoulder. So the right shoulder is higher than the head. And for the neckline, it is also the resistance. So because it is across the highs of the peaks between the troughs, shoulders and head, and it acts as a resistance level and is a crucial element in identifying the pattern. So the volume is often higher during the formation of the left shoulder and the head and decreases during the formation of the right shoulder. A noticeable increase in volume can occur when the price breaks above the neckline, confirming the pattern. So once we have a breakout of the chart, means that the chart is gonna move up, breaking the neckline. So here we're gonna have a very high volume, okay, which is gonna be confirming the this pattern, which is known as the head and shoulder bottom. So to confirm the pattern, the price is gonna be breaking above the neckline, and traders often wait for this breakout to confirm the reversal before taking bullish positions. So the projected price advance is estimated by measuring the distance from the head to the neckline and then extending that distance upward from the breakout point. This provides a target for the potential upward move. So as we said before, for the head and shoulder top, it's similar to it. We also should draw a vertical line from the head to the neckline. Then we're gonna do only a copy paste where we're gonna indicate our target, which is gonna be our take profit from here. Okay, so it's gonna be equal to the distance from the head to the neckline where the take profit is gonna take place. Concerning the double top, which is a bearish reversal pattern also, that forms after an uptrend and signals a potential reversal from bullish to bearish. As we said also, it will come after a bullish trend, where we're gonna have a neckline and a resistance, and after it we're gonna have a downtrend once the chart is gonna break out the neckline. So concerning the key characteristics of it, the price reaches a peak during the uptrend, forming the first peak of the pattern. So after the first peak, the price is gonna be making a pullback and form a trough. And after it, the price is gonna rise again, forming the second peak, which is usually close to the level of the first peak. What I mean is both of these two peaks are gonna be on equal prices. So the price here is gonna be equal to it, and the price here is gonna be equal to it. Okay, so the neckline is here, which is gonna be forming a support line, and the volume tends to be higher during the formation of the first peak. So once we have a first peak, the volume is gonna be high. Then it's gonna be decreasing during the formation of trough, and that's the second peak. So an increase in volume when the price breaks below the neckline can be a confirmation signal. So once the chart is gonna break out the neckline and the decrease, we're gonna have a very high volume, which is gonna be confirming this pattern, the double top pattern. So the pattern is confirmed when the price breaks below the neckline, and traders often wait for this breakout to confirm the reversal before taking a bearish position. And the projected price decline is estimated by measuring the distance from the peaks to the neckline and then extending that distance downward from the breakout point, and this provides a target for the potential downward move. Similar to the first two reversal patterns, we also should draw a vertical line from the resistance to the neckline. Then we're gonna do also a copy paste to it downward from here, where we're gonna indicate our target, which is gonna be also the take profit. Now the double bottom, which is a bullish reversal pattern that forms after a downtrend and signals a potential reversal from bearish to bullish. So here is our target. After it, it's gonna come after a bearish trend, a downtrend. Here is the double bottom. After it, we're gonna have an uptrend. So the key characteristics of it, the price reaches a trough during the downtrend, forming the first trough of the pattern. After the first trough, the price experiences a rally and form a peak. Then the price is going to decline again and forming the second trough, which is typically at or near the level of the first trough. And the neckline is also a resistance. Here is the neckline, so it's a resistance. And the volumes tend to be higher during the formation of the first trough and may decrease during the formation of the peak and the second trough. So an increase in volume when the price breaks above the neckline can be a confirmation signal. So how we can confirm this pattern is when the price breaks above the neckline. Traders often wait also for this breakout to confirm the reversal before taking a bullish position. So the projected price advance is estimated by measuring the distance from the troughs to the neckline and then extending the distance upward from the breakout point, and this provides a target for the potential upward move. Now concerning the triple top, which is a bearish reversal pattern that forms after an uptrend and signals a potential reversal from bullish to bearish. So here we have 3 picks. This is the difference between it and the double top. Here we have 3 picks. It comes after an uptrend, and after it we're gonna have a downtrend. So what we mean by reversal is that the pattern is gonna change the direction of the chart. So first we may have an uptrend. Then when we have a reversal chart pattern, after it the movement of the chart is gonna change and is gonna be a downtrend after it. So here are the key characteristics of it. So the price reaches a peak during the uptrend, forming the first peak of the triple top. And after the first peak, the price experiences a pullback and forms the first trough. Then the price rallies again, forming the second peak, which is typically close to the level of the first peak. And following the second peak, the price pulls back again, forming the second trough. And finally, the price rallies once more, forming the third peak, which is again close to the levels of the first and second peaks. So the 3 of them will have the same price level. Okay, concerning the neckline, it is gonna be a support level. Here is the neckline, which is gonna form the support, and the volume during the formation of the peaks and may decrease during the formation of the troughs. An increase in volume when the price breaks below the neckline can be a confirmation signal. So the pattern is confirmed when the price breaks below the neckline. Traders often wait for this breakout to confirm the reversal before taking a bearish position, and the projected price decline is estimated by measuring the distance from the peaks to the neckline and then extending that distance downward from the breakout point. So this provides also a target for the potential downward move. Similar to the others, we're gonna draw a vertical line, then do a copy paste to it where we're gonna choose our target or take profit. So here, the distance between the neckline and here is gonna be equal to the distance between the resistance and the neckline. Concerning the triple bottom, it is a bullish reversal pattern that forms after a downtrend and signals a potential reversal from bearish to bullish. So the price reaches a trough during the downtrend, forming the first trough of the triple bottom. After the first trough, the price is gonna rally and forms the first peak. And after it, the price will gonna decline again, forming the second trough, which is typically close to the level of the first trough. Following the second trough, the prices rallies again, forming the second peak. And finally, the price declines once more, forming the third trough, which is again close to the levels of the first and second troughs. The neckline is gonna be the resistance here, because it is here is the support line and here is the resistance or the neckline. So the volume is often higher during the formation of the troughs and may decrease during the formation of the peaks. An increase in volume when the price breaks above the neckline can be a confirmation signal. So how we are gonna be confirming this pattern? So when the price breaks above the neckline, traders often wait for this breakout to confirm the reversal before taking a bullish position. So the projected price advance is estimated by measuring the distance from the troughs to the neckline and then extending that distance upward from the breakout point, and this provides a target for the potential upward move. So similar to the others, we're gonna draw also our vertical line, do a copy paste to it to indicate our take profit. Similar. Now here is a different, it's different from the others. This is the rising wedge, and it is a bearish reversal pattern that typically forms an uptrend and signals a potential reversal to the downside. Okay, so here, when the chart is gonna break out the support or the neckline, the support line is gonna be the new resistance line, and it's gonna be confirming this downtrend. So here are the key characteristics of it. The rising wedges from within an uptrend, so it's gonna be coming after an uptrend. Okay. Then the sloping lines. The pattern is characterized by converging trend lines. We're discussing here the form of it. So the upper trend line representing highs has a steeper slope than the lower trend line representing lows. So we're gonna have here higher highs and higher lows. Okay, so the price continues to make higher highs and higher lows, but the range between the highs and lows narrows. So the volume tends to decline as the pattern develops. This is because the upward price movement is losing momentum. So rising wedges can be short-term or intermediate-term patterns, typically lasting a few weeks to several months. So the breakout direction is typically to the downside, and the price breaks below the lower trend line. And how to confirm it? It occurs when the price convincingly breaks below the lower trend line, signaling a potential trend reversal. So how we're gonna choose our target? Here is gonna be our neckline. This is here where we're gonna be drawing our vertical line, okay, at the beginning of the rising wedge. Then we're gonna do a copy paste for it. Here we're gonna paste it, and here is gonna be our target or take profit. In the falling wedge, it's gonna be more clear for you because I chose a picture to show you better what I mean. So here is the falling wedge. Now it is also a reversal bullish pattern that typically forms in downtrends and signals a potential reversal to the upside. Okay, so after we're gonna have an uptrend. This is why I told you in the rising wedge, we should draw it at the beginning of the wedge. Then we're gonna do a vertical line, do a copy paste for it to choose our target, which is gonna be our take profit. So it's a falling wedge. It is formed within a downtrend, and the pattern is characterized by converging trend lines. The upper trend line representing highs has a less steep slope than the lower trend line and representing lows. and the price continues to make lower highs and lower lows, but the range between the highs and lows narrows. Here we have lower highs and lower lows. So the volume tends to decline as the pattern develops. This is because the downward price movement is losing momentum also, and falling wedges can be short-term or intermediate-term patterns, typically lasting few weeks to several months. And the breakout direction is typically to the upside, and the price breaks above the upper trend line. So how can we confirm our pattern? It is confirmed by when the price convincingly breaks above the upper trend line, signaling a potential trend reversal. Now here is the rectangle bottom, which is also known as a rectangle or a consolidation pattern. Consolidation means that we don't seem to have many changes in the chart. So it is a bullish continuation pattern that typically forms after a downtrend. So here are the key characteristics of it. Now it is different from the others. So it is a continuation, not a reversal, okay? So the rectangle bottom forms after a downtrend. Here is the downtrend. Then this is the continuation. Then we're gonna have an uptrend. This pattern is characterized by two horizontal lines, a lower support line and an upper resistance line. And these lines create a rectangle or box shape on the price chart. So the price moves within the horizontal range, forming a period of consolidation. So the volume during this consolidation the volume tends to be lower during the consolidation phase, reflecting a decrease in volatility and uncertainty. And so an increase in volume often accompanies the breakout from the upper resistance line, confirming the bullish continuation. So during the consolidation phase or the rectangle bottom, we have a very low volume, but once the chart is gonna break out the resistance line, the volume is gonna be high. Okay, so the duration of the rectangle bottom pattern can vary, ranging from few weeks to several months, and the breakout direction is typically to the upside, indicating a potential reversal to the upside and the continuation of a new uptrend. So how we're gonna confirm this pattern? The confirmation of this pattern occurs when the price convincingly breaks above the upper resistance line. This breakout is often accompanied by increase in volume, as we said. Now for the rectangle top, which is also known as a rectangle, also as a consolidation pattern, which is a bearish continuation pattern that typically forms after an uptrend. Here are the key characteristics of it. So the rectangle top forms after an uptrend, and the pattern is characterized by two horizontal lines, an upper resistance line and a lower support line, and these lines create a rectangle or a box shape on the price chart. And after the consolidation phase, the price moves within the horizontal range, forming a period of consolidation. So the volume during consolidation will be very low, but once the chart is gonna break out from the lower support line, it's gonna be high. The volume is gonna be high and confirming the bearish continuation. So the duration of the rectangle top pattern can vary, ranging also from a few weeks to several months. And then the breakout direction is gonna be to the downside. And the confirmation of the pattern occurs when the price convincingly breaks below the lower support line, and this breakout is often accompanied by increasing in volume. Now for the cup and handle pattern, which is a bullish continuation pattern that resembles the shape of a teacup. it is similar, so as we can see, it is similar to a teacup shape. So it typically forms after a prolonged downtrend and signals a potential trend reversal to the upside. So the pattern consists of two parts, the cup and the handle. Okay, so here are the key characteristics of it. The cup is rounded bottom formation that resembles the shape of tea cup or a bowl. So it is formed after a downtrend and indicates a period of accumulation by buyers. The left side of the cup is a downtrend. The bottom of the cup represents a rounded consolidation, and the right side is the start of an uptrend. Concerning the handle, after the cup is formed, there is a consolidation or a retracement known as the handle, and the handle is a smaller downward sloping price movement that follows the cup. It can take the shape of a short pullback or consolidation, typically in the form of a downward sloping channel, and the volume during the cup is higher during the formation of the left side of the cup as selling pressure diminishes and buying interest increases, but the volume tends to decrease during the handle formation as the consolidation occurs, and a spike in volume may occur during the breakout from the handle. So the duration of the cup and handle pattern can take several weeks to several months to form. And the breakout direction is typically to the upside, indicating a potential continuation of the new uptrend. And the confirmation of this pattern occurs when the price convincingly breaks above the resistance level formed by the highest point in the cup, and this breakout is often accompanied by increased volume. Finally, the cup and handle top, which is a bearish reversal pattern that mirrors the cup and handle bottom but signals a potential trend reversal to the downside. So similar to the cup and handle bottom, it begins with a rounded formation resembling the shape of an inverted teacup or bowl. So this cup formation follows an uptrend and indicates a period of distribution by sellers. So the left side of the cup represents the end of the uptrend, and the bottom of the cup shows a rounded consolidation, and the right side is the beginning of a downtrend. So after the cup is formed, there is a consolidation or a retracement known as the handle. So the handle is a smaller upward sloping price movement that follows the cup. It can take the shape of a short rally or consolidation, and typically in the form of an upward sloping channel. So the volume during the cup tends to be higher during the formation of the left side and the cup as buying interest diminishes and selling pressure increases. But the volume during the handle is going to be decreasing as the consolidation occurs, and a spike in volume may occur during the breakdown from the handle. So similar to the cup and handle bottom, its duration is going to take several weeks to several months to form. Then the breakout direction is typically to the downside, indicating a potential continuation of the new downtrend. And the confirmation of the pattern occurs when the price convincingly breaks below the support level formed by the lowest point in the cup. And this breakout is often accompanied by increased volume. So once the chart is going to break out the support line, we're gonna have a very high volume. So thank you so much for watching, and in case you wanted to join our academy, feel free to scan this barcode, and thank you.